So we just did a review of what we talked about in last class. In today's class, we are going to talk about non-controlling interest. Specifically, if the parent has less than 100% ownership of the subsidiary, how to do consolidation under this situation. So this is how I'm going to organize today's class. This is actually the first part of this chapter. So we're first going to talk about non-controlling interest. What is non-controlling interest? And in the presence of non-controlling interest, I'm going to give you a brief idea how to do consolidation. And then we're going to look at the parent book. And then we're going to look at the consolidation worksheet. Specifically, there are two areas we're going to spend some time talk more in detail about. The first area is how to allocate the total net income between controlling interest and non-controlling interest. And the second part is how to calculate and allocate goodwill in the presence of non-controlling interest. So let's start. What is non-controlling interest? So the definition here is it is when, so if you still remember what we talked earlier in the course, when do we need to consolidate? We need to consolidate when control is present, when one firm has control over the other. Usually the criteria is more than 50% ownership of the voting stock, right? The FASB's criteria, but the essential criteria here is when the control is present. How do we know when the control is present? Usually we use 50% ownership as the judgment here. So when control is present, we need to consolidate. And when the parent does not have 100% ownership of subsidiary, so here the parent can has control as long as, if according to the FASB's criteria, as long as the parent has more than 50% ownership of the subsidiary, usually the control is present and we need to do consolidation. So it doesn't need to be 100% ownership. It can be 60, it can be 70, it can be 80. Under all of this situation, control is present. We need to consolidate. And if the parent does not have 100% ownership of the subsidiary, the remaining outside owners. So here we have a parent, we have a subsidiary. Suppose the parent only has 80% of the subsidiary, and the other 20%, which are the remaining outside owners of the subsidiary, those 20%, it is referred to as non-controlling interest. So can you understand it here? It's the name is very, it just tells everything right. It is non-controlling. So the controlling interest is here in this 80%. That is the interest that has control. And the rest 20%, that only shares part of the profit, but it doesn't really control anything. So that is the called non-controlling interest. And the parent, so what do we do under this situation? The parent with controlling interest, it must consolidate 100% of subsidiaries information. So specifically, as we are going to see later, the parent actually, when it does the consolidation, it is consolidated on the income statement. It is consolidated 100% of all of the revenue, 100% of the revenue, cost of the goods sold, all of the expenses of the subsidiary. The only difference here is between the previous situation when the parent has 100% ownership, and we're talking about now is we need to, after we do the 100% consolidation of all of the subsidiaries' income, we need to separate that consolidated net income into net income attribute to non-controlling interest and net income attribute to the parent. So we're going to see an example shortly, but the idea here is we first do the 100% consolidation, and then we separate the amount into income attribute to the parent and income attribute to non-controlling interest. And on the balance sheet, we consolidate 100% of all of the subsidiaries' assets, and we consolidate 100% of all of the subsidiaries' liabilities. And the separation is done in shareholders' equity part. In the shareholders' equity part, we separate an item which is called non-controlling interest in. We separate the non-controlling interest in the sub. So let's look at an example here. This is Coca-Cola's 2016 financial statement, and as you can see here, it would be the same if you look at any of the big public firms' financial statement. You are going to see it as, it is going to be called consolidated statement of income and consolidated balance sheet, because under almost all of these situations, the firm is going to have either one or more than one subsidiaries. So let's look at this consolidated statement of income. This line is consolidated net income. Actually, everything, Coca-Cola may have a lot of subsidiaries. And up until this part of the consolidated statement of income, so some of Coca-Cola's subsidiaries is maybe 100% owned by Coca-Cola. But also some of its subsidiaries may not be 100% owned. But when Coca-Cola is doing the consolidation, this part, up until consolidated net income, that is always, as long as Coca-Cola has control over the subsidiary, it is always 100% consolidation. No matter whether the Coca-Cola owns 100%, 70%, 80%, 60%, it is always 100% consolidation. And then, but what is happening here is, after the 100% consolidation, Coca-Cola needs to separate this this is in millions, so this is 6,550,000,000 into the part income attribute to non-controlling interest, which is 23 million, and the rest are income attribute to shareholders of Coca-Cola Company. So the separation is actually done in this part. And all of the above, that is 100% consolidation. And here, let's look at the consolidated balance sheet. So here, I only take Coca-Cola's shareholders' equity part, but for Coca-Cola's assets and liabilities, those are all 100% consolidation. So in other words, no matter Coca-Cola owns 100%, 60%, 55%, or 70%, it's always 100% of subsidiaries' assets and liabilities are consolidated into this consolidated balance sheet. And what is happening is here in shareholders' equity part, we're having an item called equity attribute to non-controlling interest. So actually, common stock, reinvested earnings, LCI, treasury stock, all of those are the common stock of Coca-Cola's shareholder. So all of this part adds up to equity attribute to shareholders of Coca-Cola Company. The common stock here, AOCI here, treasury stock here, those are only the common stock of Coca-Cola's shareholder. And all of the non-controlling interest equity part are here, classified here, 158 million. That is the equity belonging to non-controlling interest. But everything in this part, those are the Coca-Cola's shareholders' equity part. So, so in other words, that assets and liability, that's 100% consolidation, and separation is done in the shareholders' equity part.